So we're going to get to moving on the final part of the program, which is the trust administration process. We cover this every year. I'm just wondering how many people in the room are son or daughter of a client that's in here? We got a few. This is for you. And so, Roman, let me do this slide. Thank you, Roman. This is an overview slide because Roman's going to cover the details of these things later. When somebody passes away, it's time to call our office again and get some work done. Generally, in settling an estate, there are 4 stages to it. We can debate about whether claims or inventory come first, but claims are chasing money, like the claim to get money out of an annuity or a life insurance policy. We do an inventory, which is a list of everything that's in the estate on its date of death. We're going to have to do some tax work, and Roman's going to talk about the details of that. And then we finish, once we're all done with those things, distributing the estate. It's all yours, Roman.
Thank you, Mark. So before I get started, I do want to thank Stacy for joining the firm about 6 years ago, and I'm sure Mark has already said it. She has taken over the Medicaid planning. So many of you, Mark and I, or maybe Brenda, have done your basic estate plans. You call in for an appointment when you have an issue, and you oftentimes get referred to Stacy, and that helps me to keep my hair. So we actually have a red book here for those that can't see it, but I took a picture so we didn't have to haul it around. So we want to make sure that your successor trustees know where the red book is. And when we have an initial meeting, we want that book brought in. And the reason is, and this is very confusing to people, is we're looking for the original will that's in the tab of that book. And it's in the tab, it says pour over will. And here's the actual book. If anyone wants to see the front side of it, it'll have your name on it also. But we need the will because there's a Wisconsin statute that requires us to file the will in the residence of the county that the person lived in before they died. It does not mean there's going to be a probate. It just means that they want wills filed so there's a record that the person had a will, and when we file the will, hopefully we'll file a form with it that says this will is being filed for information only. There will not be a probate needed. And some counties want an affidavit to that effect. Others will just take a letter from us. So please make sure they know where the red book is. Please do not have it in a safe deposit box at a bank or credit union, because it can be very difficult to get access to a safe deposit box after death. So make sure if you do have one, that your successor trustees are listed as co-owners of that box. And what we mean by that is that it's not a power of attorney listing with the bank, because a power of attorney goes away upon death. And I hope there's no bank employees in here, but I'm going to tell my joke anyway, and don't be offended. But I believe the meanest, nastiest person working for a bank is the person in charge of the safe deposit box area. And I had one case, a gentleman died, and he was in his 90s. His trustee was in his 90s also, and couldn't get around real well. But when we went to clear out the safe deposit box, they had that guy going up and down the steps about 3 times. So please make sure to make it easy on your successors if you do decide to have a safe deposit box, that they can get in it. Next slide. Okay, claims. It's real simple. I think, Mark, you already gave it away.
I did.
It's money in and money out. So money in can be insurance claims. Occasionally we actually get one of those accidental death and disability claims. If you belong to a bank or credit union, they send you the form that says you get a couple $1,000s free insurance, and then they try to sell you some more. Well, if there's an accidental death, we'll help process one of those claims. About how many have we had of those, Mark?
Not many. I had my favorite case. I really love this guy. He got cancer, and then he had the good fortune, if you want to call it that, of falling down the basement stairs and dying from that. And he had opened up accounts in several savings and loans when they had savings and loans. And so we collected, I think, 6 different accidental death and disability policies. You know, he was going to die anyway, but what did him in was the fall down the stairs. So we don't see too many accidental deaths, but they come up once in a while.
So there might be insurance policies with employment or with retirees sometimes are able to maintain insurance with their previous employers. So we try to search for all the ways that the estate is owed money, and then we help with those claims. Now, money out is just the opposite. The person, when they died, owed someone money. Maybe it's the expenses of a final illness, and we want to make sure that all those lawful bills, not some scam bill that comes in that's not valid, but we verify the bills, and then we want to see that they get paid. So that's really what the claim process is. Then the next step is doing an inventory. And this, you're not expected to be able to read this. Can anyone read it in the back, Annette? What? But that's what an inventory form looks like. It may go very few are completed on one page. Usually they're 2. Sometimes they carry over to 3 pages. And the important thing to remember about the inventory is it's the date of death value. So when we put it together, we generally will ask for a first meeting to bring in whatever account statements were available at around the time of death. Sometimes it may be a quarterly statement, so we don't have anything real close to that, but we're not going to rely on that statement for the date of death, because the numbers that go on this inventory are very important for income tax determination and for the very large estates for estate tax purposes. So that's why we're going to ask for the date of death, and that's a process of mailing out letters to the various financial institutions and letting them calculate what it was on the actual date of death. And then there's a rule if the death occurred on the weekend. How did they do that, Mark?
They average the Friday before and the Monday after.
So we get those values, and then they help with any tax filings we have to do, and they also will help when it comes to basis, and I'm not going to talk a lot about basis, but it's very important for when people inherit wealth on a death. If there was a lot of gain in it, like someone who bought IBM for $100 and now IBM, I don't know what it's at now, but let's say it was at $200, at the date of death, they get a step up in basis to $200. So if they sell it after death, they don't have to pay any capital gains tax on that sale. And for a married couple, both of the couple's assets get stepped up. So it's a great benefit. And Mark, isn't it true that not every state would give that double step up, correct?
That's right, only community property states.
So you want to stay here. Next.
Don't go to Florida or Arizona's community property.
So the tax filing is something that the successor trustee will actually sign this tax return. And there's going to be a tax return that's the final 1040 return, and our firm doesn't prepare those. That's usually prepared by the tax preparer the individual had prior to their death. And for a single person, it's going to go from January 1st up until the date of death. And then for a married couple, they'll include the decedent's income up to the date of death, plus the other spouse that lives till the end of the year, their entire income will be included. But the income in most cases, from the date of death to the end of the year, may require a special 1041 tax return for a married couple, but that all depends on what kind of plan you have. Certain plans will not require that separate tax return. And then the 1041 will deal with the administration from the date of death through the distribution of the assets. And then if there's a very large estate, we would have to also do a gift and estate tax return, and that would be a Form 706. And what would we do a 709 for at death, Mark?
Gift tax. You can use a 706 to transfer unused exemption from the first spouse to the second spouse. So I got to say, you're planning on dying anytime soon, you want to get that done before 2026, because what happens is that you can so we've got a client right now that is going to transfer $12,910,000 worth of exemption to the spouse. So that spouse will have, in 2026, the exemption is going to drop to about $7 million. So they get 19 million plus 7 million. They'll be able to safely transfer to their kids $26 million. So that we use a Form 706 for that.
Okay,
Ready?
let's move on. Distributions. So when we feel that the claims have been paid, we know what the assets of the estate are, then we're going to distribute the assets to the beneficiaries. And sometimes that's going to be an outright transfer, goes in the name of the beneficiary, they put it in their own accounts. Other time we may set up a separate trust share for the beneficiaries. Now, if this can be done once at the end of the process, it usually makes us very happy and sometimes the trustee very happy. But occasionally the beneficiaries will have a financial need that can't wait. And then we can do an interim distribution for the benefit of those trustees. What we really try to do, though, is let's say there's 3 beneficiaries, let's say they're the children, and one of them has a financial emergency and say needs $50,000 to carry them through that emergency. We know the estate has sufficient income or assets in it to pay that out and still have enough to satisfy the shares the other children are getting. When we do that beneficiary, you just went through, Mark.
I'm gone. I'm
Okay,
done.
I'm done.
No, you're not.
So what we want to do is we want to have a $50,000 check written to each of the beneficiaries so that we keep them all in line. Okay.
Distributions, and the next one should be attorney's fees.
We don't want to skip this because this
Thank you,
this is
Stacy.
one of the favorite things to explain. We do want to get paid for this work. It hasn't happened very often in the last few years, But in earlier years, we used to get the child trustee successor will show up in the office, and we'll start talking about it, and we'll go through the estimated fees. And the child will say, well, my mom and dad said this was all taken care of, that you were going to handle this for nothing. And then we have to explain that, no, the base plan was taken care of, but there is a fee upon death. So I say the best estimate for routine cases. Well, I'm going to give you an example of a routine case, and then Mark can chime in and think if it's very accurate. But a routine case would be probably owning one house, couple insurance policies, maybe 2 or 3 banks, investment account or 2, hopefully not too many annuities because those can complicate things, and then maybe 4 beneficiaries. Because if there's more beneficiaries, we have to communicate to the beneficiaries, and it adds up quickly if we're communicating with more people, having to get documents back from them. So for a single person, the fee would range for a routine case between $3,000 to $10,000 about. Now for a married, with the first spouse to die, I think for about, the last 4 years, we've been stressing this point. If you have a disclaimer plan, and really what a disclaimer plan, you can know if you have one if you're part of a married couple, because if you look at the flow chart in the front of your book, if there's just 2 boxes after the first death, and one basically says all to the surviving spouse unless disclaimed, you have a disclaimer plan. And the reason the disclaimer plan is so advantageous, if you don't need advanced planning, is to administer that. Normally the fees are only between $300 to $1,000. And that's because it's very easy for the surviving spouse to take over most things. And generally the work we are doing on that is fairly simple work. We're removing the deceased spouse name from powers of attorney and either healthcare or financial, and just making it simpler than having to have the surviving spouse or the child that's the next in line have to carry their deceased parent's death certificate around to show why that person isn't no longer next in line. Now, if we have a funded marital or family trust, so this can be done now usually for larger estates where we want to take advantage of some tax planning, or if there's a special asset protection need, then we will still set up these funded marital or family trusts. And there's much more work involved in that, so the fees for those would run between $7,000 and $12,000 about. Now, the married second to spouse is very much like a single person at that point, the way that case is settled. So once again, we're between $3,000 to $10,000. And we can skip to the next slide. And again, this is sort of a summary of the things we've already talked about. The successor trustee is going to make sure that the inventory of assets and debts is prepared, the filings of claims, payment of expenses. So those are the things that the successor is going to be responsible for. Next slide. We talked about the tax forms that need to be prepared. the thing that really is helpful that we do, and I don't think a lot of the trustees would want to do this on their own without our help, is we prepare an accounting to show from the date of death until distribution where every dollar goes. The money that came in, the money that went out, and then we show what each beneficiary is to receive. We distribute the assets, and normally we'll get an acknowledgement or receipt back from the beneficiaries showing that they received what they were supposed to get. And you just, again, it's sort of a repetitious, the successor trustee is responsible for making sure all these things get done. So let's go to the next slide and say that you better act nice if you're a trustee. You have to treat if you're the trustee and a beneficiary, you can't play favorites with yourself. So you just have to use common sense and treat everyone fairly. If the funds are invested in a way, let's say that before the person died, they had a very risky investment strategy. It was their own money. They could do what they wanted with it. Now that they're deceased, it may be necessary to move the assets into safer positions. Next slide. So follow the rules in the book, carry out the wishes of the person who died. Wisconsin law says trustees are supposed to do certain things. We help our clients with that. And again, the fancy term for what you are if you're a successor is you are a fiduciary. Next slide. Oh, don't take the money for yourself. It's not your money. Next slide. Do you get paid? Yes, you do. And normally, when you get paid, it's when you're not, if you're not the sole if you're the sole beneficiary, you don't want to get paid for being a trustee. You want to waive the fee because if you're getting paid, it's taxable income. So that's has to be reported on your income tax. So we counsel people as to whether they should receive a fee, what the reasonable fee is. But in this state, it's pretty much 2% of the inventory value is a fair trustee fee. Next slide.
Yes, sir.
And this is it. You don't have to do it all yourself. You can use our firm, CPAs get involved. It's really a group effort with all the advisors that the decedent relied on during their lifetime. We try to work with them all to make sure that that everything can be taken care of, and the fees are paid for by the trust estate before the assets are distributed.